all CEOs, me included, we don't actually know what we're doing.
They're all sharks, so all you got to do, though, is know shark behavior.
I don't think we've ever talked about this before.
We can capture all of the wallet share.
First place you start is with the product.
That's just the first note.
This is the Capital Stack. Hey everybody, this is David Poole, the host of the Capital Stack podcast, where I talk to founders, entrepreneurs, and investors about all things value creation and startups. Today I am speaking to partner Austin Poole of BIP Ventures, based out of Atlanta. BIP Ventures is a platform with hundreds of millions of dollars under management, both in credit and in equity, focused on several different areas with a great track record. Austin, how you doing?
Good. Excited to be here.
I want to do something real quick.
Sure.
I want to talk about this picture that our listeners are not going to be able to see, but our YouTube people are. Hopefully it comes up soon. But what are you? There it is.
Oh, God. I was waiting in suspense. I was like,
yeah.
There better be a picture of me.
So what did the photographer tell you? Like for that pose?
I think it was something along the lines of try to be as uncomfortable as possible and act as unnatural as possible.
Yeah, and for the listeners, this is a picture of Austin in a, very Atlanta, I feel like you're like in some kind of plantation of some kind, like wooden bookshelf behind you, beautiful blazer, pocket square with his thumb just so ever gently supporting his head from his chin. No one's ever been in that position ever.
No, I was going to say, would you believe it's the first time I've been in that position?
I was just like, wow. That is powerful.
It's something.
It's something. I love it. I'd love a copy to put in my office if you've got an extra one.
Use the snipping tool. Take a screenshot.
Austin, you just made partner. Tell me about that. Tell me about the firm. And I know you were, one of the first kind of handful of 10 investors there. And tell us about your story.
Yeah, no. So the story begins before I actually joined BIP on this side of the table. I originally got to know Mark Buffington, who's the founding partner. I got to know Mark and the current team that was there when I was at a tech platform doing sales and biz dev that they were the primary backer of. And so I got to know Mark through the board function there, and frankly just kind of stayed in touch. Despite spending that brief stint of time at a early stage tech business, I went more into the traditional financial services, institutional investing path. Few different steps in that path, but ultimately ended up spending a fair amount of time at a private credit shop, putting together proprietary debt products for private equity roll-ups. Stuff that really gets your blood going.
Yeah, boring.
Bit repetitive. Really interesting. You see a lot of really amazing ways that family businesses have been making lots of money in this country for a really long time. Lots of fun stories, but pretty repetitive process. No real interest or engagement with the actual business, right? And then sometimes the buyers putting the business in harm's way with how they're capitalizing it. But it was good proving ground for kind of cutting my teeth from a finance and investing perspective. But was looking to leave that shop and get back onto the kind of the equity and business building side of things. Was either going to go into kind of more the growth equity investing side of things or go back into, an earlier stage business. Ended up, I got a job offer from a great growth equity firm here in Atlanta, and promptly called Mark, who I was still in touch with, to, basically get kind of like a little bit of like a background check on the folks I was going to go work with. It was supposed to be like a 5-minute, like, oh yeah, those guys are great, have fun, let's get lunch when you're back in town. Turned into like a couple-hour conversation in which he informed me of the places he was taking BIP and how he didn't know that I was leaving my current employer, and ended with me rescinding my offer or my acceptance from the other firm and landing at BIP. So that was a little while ago. Like you said, there was about, I think, 8 of us on the team there. We're at about 45 now, and we're currently deploying capital out of our 6th anchor fund.
And so tell me, how is that 45 like devised? Like, what is workflow?
Yeah.
How do you operationally do that?
Yeah, so I think we've got 16 heads on the investment team. We've got 5 on what we call our performance engineering team. You could think of it kind of like operating partners that a private equity firm would have, except it's set up more as like a resource center to be accessed on like a pull basis, as opposed to like operating partners get pushed into businesses. But we were scaling, and one of the things we were kind of looking around and we're like, okay, what's something that we can do that would actually kind of create additional value within our portfolios? And one of the things was, well, we always partner kind of in the same, part of a company's growth journey. And there's a lot of similar, problems being solved at that point in time. So let's get a couple of former operators from within our portfolio that have exited and put them in a position to kind of have, one-on-one relationships with the various management teams in our portfolio. So a handful of people on that team. We've got our back office. As you mentioned, we have a credit product as well. And so our back office is fairly large relative to your typical firm. And then we actually have an in-house development team. We build all of our own software that we run our business on.
Nice. Just in case you weren't busy enough, right?
Yeah,
Let's build products.
Why not? But yeah, that's kind of it.
And so how do you devise off the BIP investment focuses, right? I think there's a couple of different pods or teams in the healthcare team. So how does that work?
Yeah, so I lead our healthcare group, and then we've got another partner, Mark Buffington, the founding partner, who also is heavily involved in the healthcare side. So my team's just healthcare. Mark's team's about 50% healthcare, 50% enterprise. And then our other 2 partners are a little broader. Still, everybody's B2B software and tech-enabled services. But Dan Dreschel and Paul Foldano are they're covering 2 to 4 kind of verticals, mostly more focus on business model and stage.
Got it. And so, and from a stage perspective, would you guys classify yourselves as just primarily Series A players?
I'd say anything before Series A and earlier, right?
Yeah.
So,
got it.
We certainly don't do a ton of pre-revenue, but we have done it, right? So I can't say that we don't do that, but it's not in the middle of fairway or right down the middle for us. But yeah, we really feel like our sweet spot is coming in as a lead when a business has kind of product market fit that we can kind of independently verify, right, through our networks. That's it. And then the way that we're set up, the way our LP base is set up, we can be the primary capital provider pretty much all the way through to the company's exit, which is a little different. A lot of folks are stage focused. We're stage focused on the entry point, but then we have the capacity and kind of the history of continuing to fund our partnerships all the way through to their ultimate exit. Certainly don't have to be the primary capital provider.
It creates a pretty efficient, right? You're not bringing another person in, and you can kind of keep valuation sensible. You don't need to like have this like narrative bias where like, oh, we got to get the next big round. It's got to be 10 when you really need 3.
Yeah, that's it. Like I would say it creates flexibility or optionality for our partners. Because there's absolutely situations where maybe we led the A round and the business is kind of circling back, and you're right, it's kind of a tweener in terms of capital need. Like they only need $5 million, but it's a $10 or $15 million top line business. Mm-hmm. Nobody's going to come in and take a $5 million stake. It's not already inside the business, and so we can fill that gap pretty well. But also, if we are going for like the bigger fundraise, what we like to do, as long as the business is continuing to warrant additional growth capital, we'll write that 20, 40. We led a $200 million round in one of our businesses at the end of last year, and by kind of being around the table already and being able to say, hey, David, here's what we're willing to do, right? You'll either say, hey, that looks great. I don't want to go do a 4-month, dog and pony, trying to get an outside provider. We're kicking butt. I want to keep focusing on that. Or you'll say, hey, Austin, I think you're like 25% off market, which I'll say, great. Let's partner to go find that guy or get
exactly.
And we like that too because we're already in the business, and so if for whatever reason, if we're not viewing the pricing at a market level, we're more than happy. Because a lot of times, especially on the healthcare side, like it's great to have additional kind of smart heads and additional network under the tent as well. Mm-hmm. Right? So we love it when somebody's coming in kind of a little behind us. So it's more flexibility. It's a hell of a lot easier to raise money and negotiate the terms on that money when you already have the cash sitting in your corner.
Right. Exactly.
Yeah.
Healthcare. Been through an interesting cycle over the last couple of years. How are you viewing the market today? Because you guys will do service, you'll do SaaS, you'll do tech enabled, and will you do just plain services as well, or does it need to be have some kind of platform?
There needs to be some sort of technology component, right? It doesn't necessarily have to be proprietary.
Got it. Okay.
But there needs to be some sort of technology being leveraged that is, making the model more scalable, making it more efficient, making it more cost effective, improving outcomes. Like there has to be something being done. You're not going to see us, as it sits today with the current strategy we have, you're not going to see us, rolling up dental practices.
Right.
That's
right. Or like a staffing company, right? There's got to be,
If funny enough, we do have a staff. It's a staffing business, but it's more of a marketplace. It's one of the leader gig economy marketplaces. Yeah. But that's
okay. So healthcare today. What do you got for me? Give me the hot take.
The post-acute market's going through the house of pain right now. There's always a cycle going on in healthcare. Mm-hmm. Just a matter. Healthcare is so big. It's just a matter of who's getting the wood laid to them at what point in time. But post-acute's getting hurt, pretty bad with some of the adjustments to reimbursement, which is frankly kind of like scary as a consumer of healthcare. The average post-acute facility is like operating at like -6% operating margins. You can only do that, for a certain period of time. It'll either come out in a couple ways. Either there'll be an adjustment in the market, or there'll be a lot of consolidation, and that can be good and bad. That's one of the things we're paying a lot of attention to right now. Another is we're really big on access to care and care coordination. I think there's a lot of opportunity there. I'm a big believer that the doctors and, nurses, all the healthcare providers in our country are, educated, trained, licensed, to the hilt, to the nth degree. And, so the problem is not probably in the level and quality of medicine being practiced, right? Improvements there are going to be marginal gains. It's more about, what's happening when you and I aren't sitting in front of, Dr. So-and-so or inside a facility. And so we're really focused on, business people, folks that are coming up with business models that are more focused on the who, the where, and the how, and the when of when somebody's interacting with the healthcare system, as opposed to we need to have better practice of cardiac care or whatever.
Right. Do you have COVID, bro? Did you come on my podcast with COVID?
That's why we're doing it virtually.
What are you drinking? Is that like a Mr. Pibb? Like, what is that?
Miller Lite.
Miller Lite. Okay. Oh, it's a bubbly. Love it. Fancy.
It's a good thing you said that out loud. I forgot that some people will just be listening to this.
Yeah. Okay. So post-acute care, getting their teeth kicked in, probably on twofold, not just reimbursements, but from a staffing perspective too. Yeah. Or just getting destroyed. Why would Medicare decrease reimbursements for post-acute care if if we're trying to push people out of the hospital?
It's a good question. For the life of me, I haven't found somebody that can give me like a real solid answer. Or one where I'm like, okay, that makes so much sense. Right. It seems to be just kind of like that's what happened. It's like, well, I know that's what happened. I can't for the life of me. I don't really know. But it is one of those things that we're always kind of trying to keep our finger on the pulse of, especially if we're ever doing anything in kind of that's affected by reimbursement directly. It's a good question because there is there is this big trend right now of trying to push stuff out of the acute setting, right? And there's been an explosion of what can be done outside the hospital, which is great. Right. That's good for us. It's good for the system. So it is kind of a little bit of a head scratcher.
Yeah, no, it's so weird because I don't know if anyone's got insight into that black box and reimbursement, but it's like ambulatory surgery, for instance, a total no-brainer for a disruption perspective, taking people out of the hospital, doing minimally invasive stuff. But the reimbursements are so untenable on some of these procedures that, a lot of these companies are still struggling, yet they're like a tenth of the cost of like doing it within the hospital setting. Like, why do you think there's so much dissonance there?
It's a good question. I mean, go back in time. Mm-hmm. Hospitals weren't businesses. Right. They were like public utilities that we've now tried to turn into businesses. I mean, it's in the name administrator, right? Right. Like the key things you're trying to do is keep the lights on, make sure the OR is open, and make sure nobody's getting hurt.
So what? I mean, like it just seems to me that in a world where banks, real estate companies, Wall Street can get bailed out by a government pretty easily, why a healthcare system that, is running in the red, that provides care to people, somehow can't get like, oh, well, no, the reimbursement rates are set. You're going to have to wait till the new codes come out, Meanwhile, no one's making money and everyone's hemorrhaging. Like, how are we living in that kind of world? That just makes no sense to me.
You got everybody's pointing fingers at each other, right?
Right.
Hospital says it's, the payer, and the payer says it's the hospital, and the provider's like in the middle, like, what the heck? Mm-hmm. I think you've got a situation where you've got, multiple parties involved with incentives that are quite different. Mm-hmm. And that's going to lead to inefficiency. It's just a matter of who has the most influence at any point in time.
Right. Well, the government's getting the bill. The things aren't getting any better, and they're just saying, okay, we're just going to lower it. You guys figure it out.
Pretty much, right? Let the market forces figure it out, which, that's terrifying to hear as a consumer of healthcare, right? It doesn't take a lot of Googling to come across a lot of terrifying trends, right, when it comes to healthcare. Whether it's the shortage of physicians that we're going to run into, the fact that Medicare's got no money.
It's a whole ball of bad.
Yeah. But that'll eventually come to a head in something. And the one thing that we feel really confident about, and so it's a big focus for us, is whatever we're doing, it better be on the right side of healthcare, which for us is creating value, right? If you're not in a value-based paradigm, not good.
Yeah. You have to be in a situation where, you're doing right by the patient. You're going on risk, or at least have a line of sight in your narrative to do that. I think, going through the fee for service, jungle and just billing as much as you can, that playbook is run by the way of the dodo.
Yeah. And you can see it the rise of Medicare Advantage, right? Over half of folks on Medicare on a Medicare Advantage plan now. It's a better model. It aligns everybody, right? Everyone's kind of pointing in the same direction. So how long does it take for us to extend that model into more populations?
Right. I feel that going into that direction, the Medicare Advantage model makes pretty good sense. I'm not necessarily sure on how well they're actually managing their populations. I think that could be debatable on plans, et cetera, but something's got to change. Something's got to break. And how much do you believe in just the markets, turning the tides and making things, a little bit more feasible? Are you seeing any king making type of companies that can break a PBM, or the cost plus models, or breaking the insurance companies? Or do you just think that there's just so much regulatory capture that it's not applicable?
There's definitely a lot of that. It's also harder from the standpoint of healthcare doesn't move across state lines typically. So it's kind of hard to take the nation by storm.
Right. Yeah. There's no easy scale, right?
Yeah. It's not I heard from my cousin in Virginia that this is happening up there, and I'm like, well, yeah, I'm going to buy that too.
Right.
Unfortunately, you've got state level stuff that Medicaid's different every state you go to, right? So it's not set up in a manner where you don't get that flywheel effect as easily, right? Because you can't grow on word of mouth. You got to make sure you're checking all the boxes every time you move across another line. So, I think there's a lot of promise in a lot of this stuff. And the thing is the healthcare segment is enormous if you fold services, drug spend into it, right? So you don't have to cross. You don't have to take the nation by storm to have a really, really large impact and outcome. But, as an example, we've got a business up in Minnesota that is focused on the 18 to 64 Medicaid population that's on waivers. We have to take that model out of Minnesota and go state by state with it.
It's gonna be
a lot nicer if we didn't have to do it like that.
Yeah.
and the impact that we're having on the population that we serve is awesome, and the state's loving it. But But yeah, it's not as simple as like, okay, yeah, let's drive, 100 miles south of Minneapolis and set up shop in Iowa. You got to go through all the hoops.
How do you think about capital needs and capitalizing companies and the level of outcomes that a lot of these healthcare companies have? Because, tech-enabled services don't get valued as high as SaaS. And then when, the pure play SaaS in healthcare, usually you get restricted by TAM at some point, right? So how do you think about returns and capitalization or investing in the early stage?
On the early stage, I think it's really important from the investor side to be really, really sober about what is the immediate opportunity ahead of me and how fast can this thing grow organically. I mean, one of the things that's so attractive, like, why is everybody obsessed with SaaS as as an investment? Investment, it's not because, at least my understanding, it's not because software is just super cool. Right. It's because 80% of every dollar you make can be reinvested in earning another dollar. Right. And so as long as you're not walking into tech-enabled services with that assumption, right, and you're really looking at it as like, okay, no, only 50% or 45 or 55 or maybe 60 if you're really ripping the cover off the ball of every dollar gets reinvested, and I need to be thinking like that, and I need to make sure that the other parts of my operating expense line don't get over bloated. It works. But we went through this period of time where people were like, oh yeah, it's just like SaaS.
Dude. Yeah.
People pay every month. And it was like, oh yeah, no, but it's not.
Yeah.
And by the way, and then the most interesting thing is when I'm talking to somebody that's, it's a novel care delivery model, right? So there's actually care getting delivered. And they're like, and we think we can get our margins to 70%. And I'm like, well, somebody's losing.
Yeah. Right. Never going to happen.
Right? Like, if that's what it requires for you to get profitable, then we need to rethink about, the model. Because, yes, you need to be making a margin, but if you're making 70% margin on labor, that means the system's overpaying. Right. Yeah. And that's short term. Like, that's eventually. Yeah. Yeah. Right. If there's one thing that, I'd say CMS is good at, for sure, it's sniffing out something that's not on the up and up. Right. And so it's like, as opposed to trying to make tech-enabled services look like software, it's like, no, let's just treat it, for what it is. It's still a good business model, right? If you're creating value for people and you're doing it in an efficient manner that allows you to drop 40 to 60% of your revenue, then that can work, right? The dollars are bigger, right? Because to your right, on the healthcare IT side, if you are charging a provider group a license fee, there's only so many providers. They're under pressure on the reimbursements, so that's tough, right? And so we've got businesses that sell into software in the post-acute space, and it's tough, right? And it happens across the board, regardless of what segment, whether it's post-acute, acute, ambulatory. Right. You're dealing, everyone's been burned by software vendors, and I guess the upside on the services or the tech-enabled services side is it's baked in. The cost is baked in. It's it's healthcare. People are going to need prostate surgery, of some, regardless of how the economy's going up or down or the interest rates are affecting. Right. Yeah. No. And that's so there's a decreased risk when you're investing in a healthcare tech-enabled service, because there's an analog, a direct analog for what you're doing. Right. There's an existing market for this. Right, you as the entrepreneur or the management team has come up with a new business model, a business innovation, or a tech innovation that's allowing you to do it in a more efficient or scalable manner. So as the investor, you're not having to sit there and be like, I hope somebody wants to use this.
Yeah, right. I'm not just throwing darts on the wall.
But then, yeah, again, you touched on it, right? Services have a lower multiple, as they should. They don't. They're not as efficient. So you have to go in with like a full view, right?
Yeah, full view. Entry price matters probably more than anything, and just realize that you just can't burn irresponsibly, right? Like there's got to be, you really need to, understand your gross margin and your cost structure and, Yeah.
Yeah. It was like interesting seeing all of the direct to consumer stuff happen. Because, it's a weird thing, right? Because they actually have to acquire customers.
Oh God. Yeah.
Right. And traditional healthcare services, you don't have to acquire customers, right? You go in network, and then people just show up and say, help me.
That's nice.
Well, it's funny. It's this like it completely led to like the wasting away of a physician having muscle, or a physician practice having muscle around customer acquisition, or because it's like the easy button. You go in network and people show up. The caveat is that once you're on the smack, that can now the insurance company says, well, you know what, we think we're going to pay you less next year. Well, if you're completely reliant on being a network to generate patient flow, you're kind of like, okay, that stinks. I'll try my best. It's a bizarre situation. But so then the direct to consumer groups, right? They got to overcome that, but they're competing with the pricing and everything that's based off of $0 customer acquisition.
Right. That's
tough.
Yeah. It's not a good look. Austin, thank you so much for coming down. I really appreciate it. Dude, get like a cough drop, man. I'm worried about you.
I'm definitely gonna get some of that Dayquil going over here.
Dude, I love being high on cough syrup during work. It's like my favorite. Get Delsum. Yeah, it tastes good, and it gives you like a level of high that just makes you think of things in a different way. But anyway, everybody, thank you so much for tuning into the Capital Stack, where I talk to founders, entrepreneurs, and investors. If you like it, please subscribe, tell a friend, and we'll see you next week. Thanks. Bye-bye.
Thank you for tuning in to the Capital Stack Podcast. Make sure to share this with someone you know that can benefit from this content. Remember to support this show by rating, reviewing, and subscribing. David Paul is the founder and general partner at DWP Capital. All opinions expressed by David and podcast guests are solely their own opinions and do not reflect the opinion of DWP Capital. This podcast is for informational purposes only and should not be relied upon for decisions. David and guests may maintain positions in the securities discussed on this podcast.